Hey everybody, Mark Yegi here, and I want to just talk real quick about navigating tough markets. Right now, this is not the easiest market to navigate, and there are some tips that you need to have, and I just want to show you some history, right? So you can make a decision for yourself. So I gave this presentation to some of the people that took my Income Accelerator course over the last several years, and I think it's interesting, so here we go. All right, so one of the greatest traders of all time, if not the greatest trader of all time, is Jesse Livermore. He says there's a time to go long, there's a time to go short, and there's a time to go fishing. And I also call going, fishing being in cash. But sometimes you don't need to be in the market. Like, it's a lot easier when things are just going straight up. Being in cash is not a bad situation. He also says, first, do not be invested in the market all the time. There are many times when I've been completely in cash, especially when I was unsure of the direction of the market and waiting for a confirmation of the next move. Second, it's the change in the major trend that hurts most speculators. So interesting, you gotta understand that there's a position to be in cash, and you also have to understand that it's the change that can really hurt you or help you if you know how to navigate it. So this is going to be talking a bit about preventing pain in tough markets. So I'm going to be focusing on being in the money when you sell calls, right? I really believe the in the money strategy most of the time is a great way to trade, and it protects you on the downside as well. And it still makes you some juice on the upside, and even when it's going down. So be in the money or be in cash, and always, always, always have a trading plan. You know I always say this, right? All right, so let's start taking a look at some of the past bear markets. Here's the 22 bear market, pretty much lasted the whole year of 2022, and you could see it's a series of lower highs and lower lows, right? So here are the lower highs here. You can almost draw a line against it, right? It's a pretty solid channel. And here are the lower lows. It's a parallel line pretty much, right? So that's what happens. The stock will go up, but it doesn't go up as high, and then it comes back down. It goes up a little bit and comes back down. And sometimes you see these gaps where it really gets punished when it's coming back down. So lower highs, lower lows, and what's called a volatility contraction pattern. This move is bigger than these later moves, and these later moves start to say that the sellers are kind of coming out of it. The bottom is getting put in, and now we're getting ready to go up the other side. All right, here's the 2020 COVID crash. Notice how different this looks, right? The 2020 COVID crash just kind of went straight down over a period of 3-4 weeks, and then it went almost straight back up. I mean, it still took a while for it to recover. And then you could see the 2008 crash and the bear market that happened at the same period of time. But it's a nice channel all the way down. Nice, I say nice, but an obviously organized channel on the way down. Lower highs and lower lows. And then it kind of crashed with a gap down and lots of volume. And then it kept maybe even making a new channel on the way down. So not so fun. The 2009 recovery, though, came right after it. So you could see in March 9th, 2009, we had a channel going up the other way. See, things trend in the markets. And, you don't see them until you zoom out and look at it. And then we had a consolidation kind of after that. So if you look at the whole thing, it was this rise, then a fall, then a crash, then a recovery, and then a consolidation. It's a typical chart. Over time, this is a weekly chart that you can kind of see what's going on in the markets. Now, here's the S&P 500 2000.com crash and the bear market. Look at that. Lower highs, lower lows, all the way down for a long period of time. And this, if you look at it, went from 153 on the S&P 500 all the way down to 93. That's like a 50% drop, or maybe a 40% drop, I guess it would be. Something like that. That's not fun to sit through, right? That's when you want to be going fishing, or maybe even be short. This is the NASDAQ. It's even worse. 103.52 all the way down to 27. Look, just kept going down and down and down, and you had to wait a couple of years for this to really come back. I mean, it took a lot of years for it to come back to the top, but I mean, just to even kind of feel like you're coming back took months and months and months and months and months, years actually. So here's Amazon that was in that whole period of time. So if you were a holder of Amazon, and by the way, Amazon was a totally different company back then. They were really just selling books mainly. But still, from 113 all the way down to 810, that's a 90% drop. Like, that's tough to sit through, right? eBay was a big flyer back then. 127 was the high, and then down in the 25, 26 level as the low. And it just kept going lower, stayed below its 200-day moving average. Most of the time was below its 50-day moving average. Just not fun at all. Cisco Systems was a big winner in the late 1990s, and then it peaked out during this dot-com crash, and look at it, from 82 all the way down to 13. Really rough to be sitting through. So sometimes you'd rather just not be sitting through it, right? So let's take a look at what I'm talking about. Let's look at today. What about today? Well, here we have the NASDAQ composite, and you can see this is almost like a just a straight down pattern with a little bit. It looks like a leg, right? It's like a straight down leg with a little bit of a shoe, and there's a lot of work that is going to have to be done for this thing to even get back to its 200-day moving average. And this thing is coming down. This 50-day moving average, this is coming down. There's a lot of sellers out there. And so I know we're having some bounces. You can see 3 out of 4 of the last few days are bouncing, but they're not bouncing on huge volume. So I don't think we're done getting sold off. Of course, I know nothing. I just try to analyze the charts and see the probabilities and try to let my brain recognize the patterns. Here's the NASDAQ composite in March 2000. Notice the same kind of thing where it dropped and then it went below its 200-day moving average. So it's kind of similar. There's no exact duplicates, but boy, this looks kind of similar to me. And there were other periods of time in that drop that looked kind of similar as well. Here's Apple from January of 2022, which was a bear market year. 182 down to 154, then a bounce, couldn't make a new high to 176.85, did make a new low, and then couldn't handle it when it got back up to test that 176.65, and so it came around the other side and you could see it dropped. So it almost looks like a W pattern there, right? That's in 2022. Take a look at today. Here's Apple today. So it's made, 3/4 of that W pattern. Will it bounce? Yeah, maybe it'll bounce. I hope so. I just bought a little bit, just as a little probe position, but it may not. I mean, it looks to me like it wants to go between 195 and 200, but it did, it is stabilizing a bit in here, at least for right now. But anyway, it looks very similar to that pattern, doesn't it? So, just kind of keep an eye out on things. I'm not saying I know which way they're going. I don't. That's why I sell covered calls, because I get paid while I wait for it to go up or down. I just don't want to buy things at the top and have them go all the way down and not have a strategy. All right, something else I talk about in my courses is setting a circuit breaker. It's like a stop loss or whatever, but it's just a reason to go to cash, right? It's a line in the sand to get out and go to cash. So in trading psychology, you have to have a reason for your brain to understand why you're doing something. So giving it a reason helps you justify why you're doing something. So, for example, you might say, well, if a stock is down 20% from the high, or 20% from my entry, or 10% from my entry, some reason where you have reason to believe that, look, you can't handle it if it goes down that much. Or the stock closes below a moving average. Or the stock hits a prior swing point. And if it does that, then you can go, you could sell out at a dime below the swing point or whatever. Or you get an 821 crossover, or whatever other crossover moving averages you might use. Or a death cross, if that's the 50-day moving average moving down through the 200-day moving average. So these are all things that are kind of out there on Wall Street, and you should just have something built into your trading plan. You have a trading plan, right? All right, so here's Apple in late 21 and 2022, which we know is a bear market. Here's a couple of crossovers that were happening here. These were opportunities for you to get out. Here's a close below the 50-day moving average. Now, I believe that when a stock lives below the 50-day moving average, or it spends a bunch of time there, not a lot of good things happen. So that's a good time to say, you know what? I've got 2 consecutive closes below the 50-day moving average, or whatever. I'm going to get out. And if you got out, yeah, you might have missed this little bounce, and then you might have missed this big drop, and then you might have missed this bigger bounce, and you might have missed this gigantic drop. So there's, it's obviously hindsight. So, we know that looking back, hindsight is 2020. But there's some opportunities to get out if you got to close below the 50-day moving average. It's not a bad spot to get out, everybody. All right, here's a close below the swing point low. So it came down and hit this 167.46. It bounced up to a new high, and then it came back to test that 167.46. There's always testing going on in the market, and it didn't pass the test. It just so happens to be the same spot as below the 50-day moving average, but there you go. that would have been a good time to get out, and you would have saved, another 12 or 13 points getting out, and then maybe that had kept you out until there was a buy point or a really good spot on the chart. A death cross. This happened late in the game, and that's because it's a long developing moving average. But nonetheless, it would have saved you a little bit of this bottom panic, right? Probably not all of it. I mean, it didn't really happen until the middle of the year. But nonetheless, there's a reason that you could have used to get out. Or living below the 200. Now, most good growth stocks will test their 200-day moving average once or twice a year. Probably better said, once or twice every 18 months or so. And most of the time they'll do a little bounce, like this little 150 bounce. It tested it and it bounced right back up, and it had a lot of days in a row. So it tested it, got rid of the sellers, and it jumped back up. But when you get some closes below the 200-day moving average and it stays below the 200-day moving average, there's not a lot of buying going on in there. There's a lot of selling that's happening. And a lot of the selling happened below the 50. So even more selling here. Okay, but once you get rid of those sellers, then you can start to build the right side of the base. All right, living below the 50-day moving average, I mentioned that just briefly, and here's kind of where it is. There's a lot of opportunity for living below the 50-day moving average, opportunities to get out. If you would had that built into your trading plan, maybe that would have saved you some pain. I believe at the end of the day that cash is a legitimate position. Going to cash is fine. Now, I don't go to cash that much, but I did go to cash just a few weeks ago in a lot of my positions. I still have some small positions out there, but nothing like what I was trading before. And I can tell you, I sleep better at night when you go to cash, right? When you go to cash, you don't have to think about, are we in a down market? Is it going to open down this morning? Because there's been some really major swings. So you've got to essentially build in a trading plan and have circuit breakers built in. You've got to study past markets. You got to learn charting. Right? If you haven't learned charting, you really should, because it tells you where support and resistance are. It tells you price volume analysis, a lot of other things. And the most important thing for me, I believe, in charting is that you get your unconscious brain to recognize patterns, right? I mean, I've been looking probably over 1 million charts in my life now, and I can see patterns jumping out on the screen where those stocks are going to break out, where the support resistance is, where the tests are going to be. And I'm not saying you can predict a stock, because you can't. But you can kind of give yourself probability edges, right? And that's all I'm trying to do. The stock market is a game of probabilities, not predictions, right? I don't know if Nvidia is going to 200 or if it's going to 100. I don't know anything, right? So since I don't know anything, I'm willing to admit that and now try to figure out where are the likely spots that we're going to get bounces or tests or resistance or support, those kind of things. And how is that going to affect my portfolio? Well, right now we are in a red market, right? Or a yellow market transitioning maybe. But I think there may be some more pain ahead because it's mirroring a lot of the past bear markets that we've had. So we could be in for a little bit more pain, especially when it comes to earnings season. If so, you've got to have a plan. You've got to build a trading plan. You got to consider cash, being in the money if you're selling covered calls or being in cash, but certainly having circuit breakers and having that all built into your trading plan. All right, enough for me. I'll see you on the next video. Hope that helped. Bye. Hey, it's Mark Yagi, and if you haven't subscribed to this channel, please do that right now. That would be a great favor to me, and plus it helps me get this material out to a lot of other people that might need it. I've got a little bit of a movement going on here, and I want to try to change the world one person at a time, showing them that you can make safe, reliable income from the stock market. And plus it helps to grow the channel a little bit. Also, if you would give me a thumbs up on the video and like it, great. If you don't like it, give me a thumbs down, that's cool. But just tell me why you don't like it so I can get better. And then hit the notification bell so you can get these videos as soon as they come out, because a lot of times this is timely information and you want to get that information before it gets stale. The last thing is to join my free Insider Tips newsletter. There's a link below and you get everything in one spot. You get breaking news and analysis also. So that would be great if you could do that too. See you soon.